Welcome back to Who's Fi TV. Today we're going to be getting into some more financial literacy and real estate talk. So make sure you guys hit that subscribe button, click the notification bell so you're notified every single time I drop a new video, and you turn that thumbs up button blue. I'm actually gonna give you some time to do that right now because I think you guys think it's a game and it's not. So go ahead, do that right now. And
Yes, Mom? Okay, but my car's in the driveway. When? In like an hour?
I guess I'm actually leaving the car. So let me just go do that really quick. In the meantime, you guys go ahead and click those buttons. I'll be right back. Okay, so now that that's out the way, and y'all have presumably clicked the buttons like I said, let's get into things. Okay, so, what are we gonna talk about again today? Qualifying for a mortgage. Okay, so today we're gonna be talking about qualifying for a mortgage. And I think this is the perfect topic for you guys to listen to me about, because why? I'm the mortgage broker for you. So I'm very, very well versed in what I'm about to say. So before we get into anything here in terms of, what's the best ways to qualify and what are the things that are gonna be important in regards to qualifying, let's start with what a mortgage is. So, unless you are someone who is absolutely balling and can buy a house outright straight cash, you're gonna need to mortgage some of the cost to buying said home. So you're gonna have your down payment, there's gonna be a purchase price, whatever the down payment does not cover from that purchase price is gonna be mortgaged to you. So basically another institution or a lender is going to be paying for the remainder of that purchase price and then having you pay them back over the course of time. So that's essentially what a mortgage is. It's just a bigger loan that you're gonna be paying back to the bank over the course of time because they helped you purchase the property because you couldn't buy it out in full at the time of. There's no shame in that, by the way. I know a lot of people like to say, oh, I bought this out straight cash. I bought my whole car out straight cash. Well, listen, if you can come up with $500,000 straightforwardly, then by all means, don't have a mortgage. But for those of you like us, a mortgage is pretty essential. So now that we got that out the way, let's actually focus on the factors and the components that are considered to help you qualify for this mortgage, right? So let's start with the most important and the most vital. First things first, income is king. Your income is going to be one of the biggest driving factors in you qualifying for a mortgage because let's face it, you have to make money to be able to afford to pay back this loan. And the lender, in this case, which is the institution or the bank, they're not going to give you any amount of a loan just to anybody unless you can afford it. You have to show that you're able to handle the payments that come along with paying back this loan, right? If you're someone who makes, $10 an hour, there's no way that me as a lender is going to feel comfortable lending you $1 million because how are you going to pay that back with what income? And when will you have the money to muster up to pay back that loan in a reasonable amount of time? So therefore, your income is going to be very, very vital in how much of a mortgage you qualify for. So typically on average, you're looking at about 5 times your annual gross income. So if I'm someone who makes about $100K a year, I can look forward to maybe on the surface about $500,000 being available to me in the form of a mortgage, right? But it's not that simple, it's not that cut and dry because not everything is really that black and white. And we're gonna lead right into the second point with that one, and that's gonna be your debts. So to offset that income, we've got the debts, right? How much of my income is going to things that I'm already obligated to pay back already before even looking at this property, right? Because that's something that a lender is gonna look at, right? They wanna make sure, okay, yes, you make a lot of money, but how much of your money that you make is free to go to this mortgage when I give it to you, right? And that could be really the determining factor in figuring out how much that you qualify for. Because I make $600 in monthly payments already, I'm gonna actually end up losing about $100,000 in mortgage amount being lent out towards me, right? So you can see how quickly making a lot of money can really lead to not being lent as much money if I have a lot of debts outstanding, right? But the great thing about this equation is that you don't have to do this by yourself. If you're someone who's going through the house purchasing process, you know, in tandem with somebody else, and you have a co-applicant, then it's both of you guys' income and debts combined as well. So, you know, if I've got 100K that I make gross annually, and you know, the person that I'm gonna be purchasing with also makes 100K annually, congratulations, we both now have 200K between the two of us to pay back this mortgage we're trying to achieve, right? And then let's just say I have my 600 that I pay monthly to my prior obligations, and they also have 600 that they pay monthly to their prior obligations. Well, now we still qualify for a pretty healthy amount, because it's both of our income and our debts put together that still equal out a positive number to go towards qualifying for this mortgage, right? So it's all about the usable income. How much of your income is still available to pay back this mortgage after factoring all the debts that you currently have to satisfy, right? So how much of your income is still freed up at the end of the day after satisfying all your prior obligations already, right? That's what's key here. So those are the two factors and how they go hand in hand, and why they're so vital in determining where it is that you're even starting in terms of how much mortgage can be allowed to you, because that's going to be something that is really crucial for a lender in their position to say, okay, you know what, this person or persons or people, persons, I know I see that in writing all the time, if they have the S at the end of persons, and I'm not sure if I'm supposed to say that, but you know, it sounds weird coming out of my mouth. So people, what's their capacity to, like, how much can they handle, so that I know that they're good to afford to pay me back. We're starting right there, because regardless of anything else, if you don't have or make the money as of right now to handle the money that I'm going to be lending out to you and expecting to be repaid back to me, what are we even talking about, right? So that leads us into factor number 3, which is your credit score. That's going to be a really big deciding factor in terms of what type of mortgage you get qualified for and how much you qualify for, right? Because let's face it, your credit score really is an indicator of what type of person you are in the borrowing space, because that's essentially what you're doing. You're borrowing this money, you're paying it back over the course of time, and your credit score tells a story about who you are in this regard, right? It tells you know what your repayment history is like. It tells us, you know, how well do you deal with being leveraged with money? You know, how well do you handle having a lot of money accessible to you? What are your patterns like? What type, who are you? That's what your credit score tells people in the financial space. So your credit score can be really indicative to a lender of if you're someone that's good or not to pay this money back. Are you good for it? That's really what your credit score is going to be telling them. So if you're someone who falls below that minimum credit score requirement that a lender may have, why are we going to now lend you more money if you've shown irresponsibility to handle smaller amounts? Why would we give you a bigger amount, right? So that's why your credit score is really one of the determining factors in terms of qualifying for a mortgage and how much you actually qualify for, right? Because through your credit score, a lender or an institution is going to be able to really see what type of person you are in the financial space. What are the patterns and the habits that you have in borrowing and repaying smaller amounts of money? Because this is probably going to be one of the biggest loans that you ever have to pay back. So they want to make sure that you have practice doing it on a smaller scale so that you're more likely to make good on this bigger debt that you're about to take out, right? Because that's what it is. This is a bigger loan that you're gonna be paying back over the course of a longer period of time than you're probably used to. So if you can do it in a smaller scale, they wanna make sure that you can do that before they lend it to you on this bigger scale, right? The fourth and final factor that goes into qualifying for a mortgage is gonna be your down payment, right? Your savings. How much are you putting into this property? How much of your own money, your own capital, your own equity are you putting into this property, right? Because let's face it, if I'm going to be giving you a large amount of money, I need to make sure that you have enough stake in this to take this seriously, right? And the minimum down payment requirement in Canada here is 5% down, right? And if you're putting down that 5%, there's going to be other stipulations that are put into place because you're going for a high ratio mortgage. And what that means is any mortgage that ends up being 80% of the purchase price or more, right? So if your down payment is 20% or less, it's automatically a high ratio mortgage in Canada, right? And that just means how much of the money going into this purchase is going to be yours versus the bank's money, right? And that is going to be really indicative because once you are in a high ratio mortgage scenario, you now have to have mortgage insurance put in place, right? I know a lot of people hear CMHC. CMHC is one of the bigger insurers for mortgages, and that is not to help you. That is for the bank or the institution or the lender that's actually paying this mortgage for you, that you're gonna be paying this mortgage back to over the course of time. And that's in place because it's just in case you default. And the fact that you have put down less than 20% means that, you know, there's a larger risk that you may default on your payments because you have less leverage into your property, right? So they want to have the proper protection in place to save their ass should you default on your payments for whatever reason, right? And that's an extra cost. That's a cost and a premium that you pay in addition to your mortgage, right? That's not going to just get filtered in there and it's for free. That mortgage comes with a cost and you pay it. You pay it every payment that you make, whether it be weekly, bi-weekly, monthly, and it's a premium that gets thrown into your mortgage overall. So if you thought you were mortgaging $500,000 and that $500,000 ends up being more than 80% of the entire purchase price, you're gonna have mortgage insurance added into that mortgage amount. So really what you thought was $500,000 is probably gonna be about $520,000 instead now, because you have to pay for that mortgage as well as the premium, and you have to pay that back over the course of time now. So you're dealing with bigger mortgage payments now because of the smaller amount that you put into the purchase initially through your down payment. So that's just something to be mindful of. That shouldn't be what makes or breaks you getting into the real estate space. However, it is something to be mindful of if you're close and you're on the cusp of 20% down payment, right? Like if you're someone who's got, you know, maybe 17% down payment for your purchase, maybe it might be in your best interest now to get that extra 3% to get you to the 20 so that you're not paying for mortgage insurance anymore. You don't need to, it's not a requirement. And that would decrease your monthly payments significantly because that's a whole insurance premium that you no longer have to be obligated towards, right? So that's nothing to do with qualifying for the mortgage, but that's just something else to keep in mind when you're going through this process, right? And I really want people to be cognizant of that because once you reach that 20% down payment mark, you're now eligible for other benefits and other incentives now once you hit that 20% down payment threshold, right? So maybe that might be, you know, amortizing your mortgage over a longer period of time, which means that your payments are now spread over a longer period of time, which means your payments are smaller, right? Like who doesn't love that, right? That's another benefit to getting that 20% mark and having a non-high ratio mortgage. It's called a traditional or conventional mortgage. Let me double check that real quick. So yes, that could be the difference between you having a high ratio mortgage and a conventional mortgage, right? So those are the 4 factors that really dictate how much of a mortgage you qualify for. And I hope you guys realize how formulaic the entire process is, right? Like there's no one size fits all because there's so many different contributing factors. And that's all the more reason why you should get a pre-approval in place, right? So what a pre-approval is basically going through this entire procedure preemptively to assess your financial situation to see exactly how much you qualify for before you even enter the real estate space to submit offers and you start shopping around so you know your budget. This is done all in advance proactively so you can see now, okay, this is where my budget actually is. Maybe I know what to do now to increase my budget. Maybe I'm cool to where I'm at so I can start, you know, getting into the market and you know, I can start to look for stuff that fit within this price margin so that I can comfortably purchase and confidently, right? Because the last thing you want to do is do what I did when I first got into the real estate space and get no pre-approval. You go find the house you like, you get it, and then when it comes to closing now, you're like, oh, how do I qualify for this? I don't. How do I actually close that gap now? Because that's what happened to me. And I don't want no one to have to go through what I went through because back in 2018, I was running around like a chicken with his head cut off because I did not do a pre-approval. I didn't know what my actual budget was. And when it came to closing, I didn't actually qualify for the mortgage I needed right away. I had to close that gap. So I had to go get myself a little knick-knack job. And I worked at a place that I will not mention on this video for a very short amount of time just so that I could claim the income and then I could qualify for that mortgage. But the point is, I don't want people to have to do that out of panic because that was something I did out of desperation. I don't want anybody to have to move desperately, right? And the goal is to be able to make moves comfortably, confidently, and wisely. And that is why I want you guys to be as informed as possible. So that being said, make sure you guys take your notes, make sure you stay on top of things, and you are proactive. The best thing that you can do when it comes to being in the real estate space is plan ahead. Have a plan in place, be strategic, and know yourself. That is key. That said, before we log off for today, make sure you guys hit that subscribe button if you haven't already. Throw a thumbs up on this if you learned something. Comment below what you think is the biggest hurdle that you need to work on clearing when you want to get into the real estate space. And we're going to see you guys soon. Peace.